The U.S. housing market is experiencing mathematically improbable conditions. The lowest transaction volume since 1995, meaning fewer homes are selling than at any point in 30 years, while home prices are simultaneously near all-time highs. This disconnect, fewer buyers and higher prices, defies normal supply and demand principles. The market feels frozen, with absurd prices and a median first-time buyer now 40 years old, indicating a deep structural issue. The median existing home price is approximately $418,000, a stark contrast to the $272,000 median price in 2019, representing a 46% national jump in just 5 years. Mortgage rates are around 6.5%. This is significantly higher than the 2.65% for a 30-year fixed mortgage available in January 2021, representing a fundamentally different financial landscape. For a $400,000 home with 20% down, $320,000 mortgage, the monthly payment at 2.65% was $1,293. At today's 6.5%, that same loan costs $2,023 monthly, an increase of $730 per month for 30 years. This means paying more for both the house, up $146,000 in 6 years for the median home, and the loan simultaneously. This situation is the result of specific decisions and shocks over the past 5 years. In 2020, the Federal Reserve slashed rates to near zero and injected $120 billion monthly into the financial system through bond and mortgage-backed security purchases to combat the pandemic's economic impact. By January 2021, the 30-year fixed mortgage rate hit a record low of 2.65%. This enabled buyers to afford significantly more house for the same monthly payment, fueling a buying frenzy. Compounding this, COVID-19 shifted housing needs. Remote work surged from under 6% to over 18%, prompting millions to seek larger homes in more desirable locations, leaving urban centers like Manhattan and San Francisco. Cities like Austin, Phoenix, and Boise experienced a stampede of buyers. National home prices jumped 37% between March 2020 and March 2022. Austin climbed 61%, Phoenix 59%, and Boise 53% in just 2 years. At the peak, nearly 6,000 homes sold for $100,000 or more above asking price monthly. Buyers in 2020 to 2021 likely made highly advantageous financial decisions purely by accident due to timing. By mid-2022, with inflation at 9.1%, the Fed initiated an aggressive rate hike cycle, implementing 11 hikes in 16 months, raising rates from 0.25% to 5.50%, the fastest tightening in 4 decades. Mortgage rates surged, from 3.22% in January 2022 to 7.08% in October 2022, and peaking at 7.79% in October 2023, the highest since 2000. This dramatically increased borrowing costs. The $320,000 mortgage that cost $1,293 at 2.65% now costs $2,302 at 7.79%. This is over $1,000 more per month, or $363,000 more over the loan's life for the same house. To qualify for the median-priced home at today's 6.5% rate, an annual income of around $106,000 is needed. This exceeds the median household income of $83,700, leaving the average American family $22,000 short annually. Each quarter-point rate increase effectively removes about 1.4 million potential buyers from the market. Home sales fell from 6.12 million in 2021 to just over 4 million in 2023, the slowest 3-year stretch since the mid-1990s. We sell fewer homes today in a country with 100 million more people than in 1995. Despite this demand collapse, prices haven't fallen. The median price hit a record $407,500 in 2024 and has remained near that level. Demand and supply collapsed simultaneously, creating a total market freeze. This is driven by the lock-in effect. Approximately 51% of U.S. mortgages carry a rate below 4%, and 20% are below 3%. Homeowners with sub-3% rates are unwilling to sell and surrender their historically low borrowing costs for a new mortgage that could cost more than twice as much. This lock-in penalty can exceed $65,000 in lost lifetime equity. This effect reduces homeowner listing probability by 21 to 23% and has suppressed an estimated 1.7 million transactions. Active inventory remains 17% below 2019 levels, with a month supply between 3.3 and 3.8, well below the 6 needed for a balanced market. For Maya, a 31-year-old making $74,000 annually with excellent credit and $31,000 saved, homeownership is unattainable. The median home in her city is $385,000. With 10% down and a 6.5% rate, her estimated monthly cost is $3,010. This $3,010 represents 65% of her take-home pay, $4,650, leaving only $1,640 for all other expenses. The income required to comfortably buy the median home in her market is $110,000, creating a $36,000 annual gap. First-time buyers now comprise only 21% of purchases, a 44-year low, compared to the historical norm of 40%. The median age of a first-time buyer is 40, up from 28 in the early 1990s, costing buyers roughly $150,000 in lost lifetime equity. Baby boomers constitute 42% of buyers, many paying cash after selling appreciated assets. Meanwhile, 32-year-olds struggle with bidding wars and limited savings. Consequently, 84% of Gen Z aspiring homeowners are delaying life milestones. The U.S. is short an estimated 3.5 to 4.5 million housing units. After 2008, builders drastically reduced housing starts, averaging only 990,000 annually in the 2010s against a historical baseline of 1.5 million. The construction that did occur skewed towards higher-end markets. Starter homes under 1,400 square feet, once over 400,000 units annually in the 1970s, dropped to just 65,000 in 2020, an 80% decline. Material costs have also surged due to tariffs. Steel and aluminum are up 50%, and Canadian lumber is up 45%, adding an estimated $10,000 to $17,500 to the cost of each new home. This supply problem will take at least a decade to solve. This is not a repeat of 2008. Subprime mortgages were 18 to 21% of originations then. Now they are 3.6 to 4.2%. The median credit score at origination is 758, significantly higher than in 2006. Crucially, only 2.2% of mortgage properties are underwater today, compared to 26% in 2009. Homeowners hold $35.8 trillion in equity, and foreclosures in 2024 totaled 174,100 versus 2.3 million in 2008. The current market is not fragile but frozen, structurally constrained, and deeply expensive. A crash creates opportunities, but a sideways grinding market absorbs income and waits for time to resolve issues. A significant drop in mortgage rates is needed, but forecasts suggest rates ending 2024 between 5.7% and 6.1%. However, 37% of homeowners won't consider selling until rates drop below 5%, a threshold unlikely this year. The lock-in effect is fading naturally as mortgages below 4% have dropped from 65% to about 48%. This slow release is the most realistic path to a functional market, likely a 5 to 10-year process. A dramatic rate drop could temporarily worsen affordability. Pent-up demand flooding the market would hit insufficient supply, potentially causing prices to spike again, as seen from 2020 to 2022, before long-term improvements occur. The most honest forecast is a slow, multi-year correction where prices move sideways as incomes gradually rise. This involves difficult personal decisions rather than a dramatic crash or immediate relief. Those in their late 20s and 30s face the most dysfunctional housing market since World War II. It's insidious, feeling like a permanent new normal rather than a crisis, with institutions incentivized to promote buying regardless of individual circumstances. The income required for the median home, $106,000, versus median household income, $83,700, presents a $22,000 gap before any personal expenses. The math is broken, not a personal failing. Buying makes sense if total monthly housing costs are below 28 to 30% of gross income and you plan to stay at least 7 years. Stretching to 45% based on agent advice is financially unsound and makes one a future statistic. Renting and investing the difference is a legitimate strategy that offers competitive or superior returns in a high-rate, high-price environment, a fact rarely highlighted by those earning commissions on sales. For new construction, look for builder rate buydowns to 4.5 to 5%. While median new home prices are at parity with existing homes, ensure incentives don't mask an inflated base price. Always run the numbers meticulously. The market is a product of 30 months of historically cheap money followed by the fastest rate hike cycle in 40 years, layered on a decade of underbuilding, leaving the U.S. 4 million homes short. Those needing prices to fall are priced out even if they do. Sellers are trapped by low rates that previously made housing affordable. Everyone is stuck for opposite reasons, and no single policy or rate cut can fix this structural imbalance quickly. The era of buying any house at any price assuming appreciation will bail you out is over. Running the real numbers before signing is not pessimism. It's the only sane approach to this expensive and broken market.